Welcome, everyone. My name is Liz Polson, and I am a marketing specialist here at HomeSphere. Thank you for attending today's event. We'll be covering the current outlook for the U.S. housing market presented by Morgan Stanley. HomeSphere and Morgan Stanley have been working together for over a year on a residential home builder survey initiative. If you're a builder in our network who has taken the time to participate in the survey over the past year, thank you very much. If you have not, we encourage you to do so in September. The survey results are published monthly and are exclusively offered to survey participants. As an added bonus, one randomly drawn participant receives an iPad mini Retina as a thank you each month. At the end of today's presentation, I will announce the winner of this month's prize, so stick around for that. We know today's topic is of high interest as we welcome nearly 500 attendees registered for today's event. Presenting on behalf of Morgan Stanley today is Ryan Gilbert. Ryan is an equity analyst in the research department. Ryan has nearly 5 years of equity research experience and has been covering the home builder sector since 2012. Ryan holds an economics degree from George Washington University. We know you are all busy today, so this event will run approximately 30 to 35 minutes, including time for questions. If you have questions for Ryan as he's giving his presentation, please use the GoToWebinar question or chat feature. With all that said, I'll now turn the presentation over to Ryan.
Thanks, Liz. Good afternoon, everyone. I'm happy to have the opportunity to present our views to all of you. Just as a quick housekeeping before we get started, for important disclosures, please see the Morgan Stanley Research Disclosure website at www.morganstanley.com/researchdisclosures. All right, so the topics that I'll be covering are our 2015 housing outlook and housing estimates for important metrics. First-time home buyers, and then the extent that we should be fearing an increase in interest rates in 2015, as well as the results of our recent survey that we conducted in the beginning of August. It's the July Morgan Stanley HomeSphere survey. So just jumping right into it, I'll present the Morgan Stanley 2015 housing outlook, which for those of you who were able to join us in January, this should look pretty familiar because the outlook has really not changed. The year is progressing around as we had expected. So just to run through the outlook, we're looking for 1 million household formations by the end of 2015, home price appreciation of 4 to 6%, new home sales of 500 to 550,000, total housing starts of 1.2 to 1.3 million, and single-family housing starts of 700 to 750,000, and then existing home sales between 5 and 5.25 million. All right, so jumping in, the first slide is our formations estimate. So we're looking for 1 million formations by the end of the year. The household formations estimates come from the Census Bureau, their housing vacancies survey, and it's important to note that the census is currently reviewing the survey, so we should take the results with a grain of salt. However, it's an important survey to show trends in household formations as well as the home ownership rate. So when we presented to you in January, we were running well below the long-term average of 1.2 million household formations a year. And the good news is that the rate has turned strongly positive in the beginning of 2015, and it's actually running ahead of our 1 million household formations by the end of the year estimate. The estimate in the first quarter was 930,000, and in the second quarter, the formations estimate was 1.3 million. So average of 1.2, running ahead of our 1 million estimate. So that's good news. So the chart on the left down here shows you formations over the past several years, so back to 2001. So here's our 2015 estimate, 1 million, still below the long-term average of 1.2. But you can see here in the first quarter of 2015, the second quarter, we're running ahead of our 1 million estimate. So there's a possibility that we'll run ahead of 1 million formations but a positive, certainly a positive start to 2015. On the less positive front is that the formations have been net renters. So owner households lost an average of 350,000 owners in the first and second quarter, and renters gained an average of 1.4 million. And so that's this chart on the right is showing you owner formations and renter formations, and then the home ownership rate. So the home ownership rate is trending down towards 63%, which we think is sort of the new equilibrium rate, which is 2 percentage points lower than the long-term average of 65%. All right, moving on to the next slide. Our 2015 home price appreciation estimate of 4 to 6%. This is from the Case-Shiller National Home Price Index. It's trending towards the midpoint of our estimates. So you can see when we presented in January, the rate of growth of home prices was decelerating rapidly from the very strong growth that we'd seen in 2013 and 2014. However, that rate stabilized in the beginning of 2015. So you can see home price appreciation through May is in that low 4% range, and we think that we're going to end the year probably in the mid 4 to 5% range, but still sticking with the overall 4 to 6% estimate for home price appreciation. All right, the next slide is our 2015 new home sales estimate. We think that we're on track for 500,000 to 550,000 new home sales. That would be 15 to 25% growth year over year from 2014, which came in at 436. So this is a measure that's released monthly by the Census Bureau as well. So we look at this both as a seasonally adjusted annualized rate, which is released by the census, and then on a trailing 12-month rate. So we're on track towards the range. The trailing 12-month rate of growth is 15% through June. So you can see our forecast in January. In January, we'd been running in the low single digits growth rate, and we were forecasting an improvement to 15 to 25%. And we did see that through June. So this is, again, the trailing 12-month growth rate. You can see we've at 15%, we're moving towards the low end of our growth rate range. And this is just this chart is, or this slide, I should say, is another way of visualizing our forecast. So the chart on the left shows you the seasonally adjusted annualized sales rate, which has been trending within our 500 to 550,000 range throughout the year. In June, it dipped below at 482,000. But on a trailing 12-month basis, we're approaching the low end of the 500 to 550K range. We're at 485,000 new home sales on a trailing 12-month basis through June, so really right below that 500 to 550K range. So we think that new home sales have been growing on a higher inventory of new homes. So there's just more homes available for home buyers to purchase, a lower inventory of resale homes, and just an overall improving economy. And our expectations for growth are capped by this secular shift towards renting. So we're seeing the equilibrium homeownership rate decline further from here to 63%. We're seeing constraints to mortgage credit, although this is slowly improving. And then that's it, actually. So we think at the current rate, we're trending more towards the low end of our range, so 500 to 525K. And it's important to note that the 500 to 525,000 new home sales estimate is 20% below the long-term average of 660,000. So we think that there's considerable runway for growth just to get back to the long-term average and not even to move ahead of it. All right, so why are we looking at, why do we follow new home sales? It's because new home sales and home builder orders or net contracts are closely correlated. So the chart on the left is showing you the new home sales monthly growth rate, and we're comparing that to public builder orders, which are reported on a quarterly basis. And you can see that they're 85% correlated if you look at this metric back to 2004. The chart on the right is showing you orders growth and new home sales growth in the past 3 years. So from January to present, and we're running at plus 15% through April, and then 14% in May and June for the builders that have reported. So there's several off-cycle reports whose numbers we don't have for May and June. So of the builders that are reported through June, we're at 14%. All right, moving on to our next slide, our 2015 estimate of housing starts, which is again reported monthly by the Census Bureau. We're looking for 1.2 to 1.3 million housing starts. That's 20 to 30% growth, and single-family starts of 700 to 750,000. So that's 8 to 16% growth. So our starts estimate is driven on the multifamily end, and we are seeing that growth rate trend probably towards the lower end of our range, 1.2 million. In June, the seasonally adjusted annualized rate was at the low end of our range, and again, that was driven by the multifamily segment, which at 498,000 starts would be a 48% increase over the rate in June of 2014. So the chart on the left here is the chart that we presented to you in January. So for single-family housing starts, so we were running at a low single digits growth rate, forecasting modest improvement from there. And as you can see from the chart on the right, we are seeing some improvement in the single-family starts growth rate. It's been a little choppy, but we're still expecting it to get to that 700 to 750,000 range. All right, so this is total starts, and again, just another way to view our forecast relative to the results that we've seen this year. On the chart on the left is showing you seasonally adjusted annualized total starts at just under 1.2 million in June. That's approaching the low end of our range. And then on a trailing 12-month basis, which is the chart on the right here, we're a little below 1.1 million. So we still have there's still some work to do here to get to that 1.2 million range. But again, we've got the second half of the year to get there. And then single-family starts, we've been running right below 700,000 for most of the year, 685,000 in June. This is the seasonally adjusted annualized rate. And on a trailing 12-month basis, we're really right below that 700,000 range. We're at 680, so we're approaching the 700,000 starts range, which we think that we can get to by the end of the year. All right, and then lastly, we have our existing home sales estimate, which is 5 to 5.25 million, or 1 to 6% growth from 2014. Existing home sales is released by NAR. It's also called resale. So homes that have previously been built and owned, sold before. It's really been a standout in the spring and the summer. The growth rate turned positive in April and is now trending towards the mid to high end of our range. You can see in January that growth rate was still negative, but it's since turned around and it's turning positive and is heading towards the high end of our range of 1 to 6% growth. So it's getting closer to 6% than to 1. And the June seasonally adjusted annualized rate of 5.5 million was actually well above the high end of our 5.25 range. All right, so moving on to the first-time buyers. The return of the first-time home buyer as a force in the market has been a closely watched issue by us and by investors. We wrote about this in February in our Is Housing a Zero-Sum Game report. And so we're seeing indications that this buyer is returning to the market, although it's not really evident thus far in the new home sales data. So this is showing you trailing 12-month new home sales by price bracket. So that sub 200K price point is still negative on the year, but we're only down 6% in June, and we were down as much as 18% throughout 2014. So that's this chart right here. So you can see the growth rate for sub $200,000 homes is still negative, but it's improved a fair amount from the lows near the end of 2014. Where we have been seeing a turnaround is in resale. So this chart uses data from the NAR. You can see a pretty strong turnaround in the first-time home buyer here. It turned positive in April and is running close to 10% growth year over year. So it's important to note here that while it does appear that there's evidence that this buyer is returning to the market, the builders that we follow are split between whether they're returning in sufficient force to be able to justify additional investment in this segment. So building communities focused on the first-time buyer. First-time buyers typically command a lower gross margin than move-up or luxury buyers, so you have to compensate for that lower gross margin with higher volume, so you can generate operating leverage. And some builders aren't really seeing the volume necessary to invest further in that segment. So we're expecting the first-time home buyers to be more pronounced in the new home market in 2016, as some of the larger builders are shifting their focus to this segment, so they are seeing the volumes to justify more investment. But it's a slow-moving process, so we think that there's going to be more product at that 200K price point, that sub 200K or around $200,000 price point for first-time buyers to buy in 2016. So why are they returning to the market? Aside from just general improvements in the economy and in the labor market, affordability for the first-time buyer is well below long-term averages. So this chart on the left, the yellow line is showing you debt to income for first-time home buyers, and then relative to the long-term average, which is this yellow dotted line right here. So in the beginning of 2015, the Federal Housing Administration cut the mortgage insurance premium 50 basis points. That moved the debt to income ratio for first-time buyers down to 20.6%, which is the lowest level that we've seen in our data set, which goes back to 1990. So that's right here, and it's well below the long-term average of 23%. You can see the debt to income ratio ticking back up in 2015, which is just due to an increase in interest rates throughout the year. But it's still well below the longer-term average of 24%. So affordability has certainly been a big positive for first-time home buyers, but on the less positive side, we expect first-time home buyers to be more rate sensitive than just the overall home buyer market. So we estimate that a 100 basis point increase in mortgage rates from current levels would push debt to income ratios for first-time buyers above that 24% long-term average. And it would take a 200 basis point move to push the DTI just for all buyers above the long-term average. So the first-time home buyers is more exposed to increases in interest rates than buyers on whole or in general, which is a good segue into should we fear an increase in rates? So we're sort of sitting on the cusp of a rate increase by the Federal Reserve. This is another issue that we've written about before, and we thought would be important to highlight here. In 2013 and 2014, as I'm sure a lot of you remember, mortgage rates moved up 100 basis points and really negatively impacted consumer demand. So it was the taper tantrum in May and June of 2013. And so this chart on the left is showing you mortgage payment growth on whole from 2011 to 2015. And then this gray line here is orders growth, and the yellow line is new home sales growth. So you can see that as mortgage payments shot up in the summer and fall of 2013 and into 2014, that the rate of growth of new home sales and then orders fell pretty dramatically. So orders went from plus 30% to flat in the space of a couple months, and new home sales went from plus 20% to flat. Although we're looking at it on a trailing 12-month basis, so it's showing a more gradual rate than what we actually saw on the ground. So clearly, demand was negatively impacted in 2013 and 14 in part by higher rates. Over the longer term, which this very busy chart is trying to show you, is that new home sales and interest rates are uncorrelated. So if you do a scatter plot of new home sales growth and 10-year Treasury yield, it shows no relationship. So over the long run, we're not really expecting. We wouldn't expect interest rates to negatively or positively impact new home sales growth. So why do we think 2015 is different or has been different than 2013 and 2014? 3 reasons. The first is that mortgage rates have been lower on an absolute basis than 2013 and 2014 and are increasing at a much more moderate pace. And that's what this chart on the left is showing you. The blue bars are 30-year fixed mortgage rates. So you can see that from April to June, to July, I should say, we went from 3.5% to 4.5%, so in the space of a couple months. We've seen an increase in mortgage rates over the course of 2015, but it's been at a much more gradual pace than in 2013 and 2014. And home buyers are also getting a benefit from a significant deceleration in home price appreciation. So you're not getting that twin negative of higher mortgage rates and then also significantly higher home prices than what they had seen in the previous year or in the previous couple of months. So this chart on the right is showing you the year-over-year growth rate of the FHFA, so it's the Federal Housing Finance Administration Purchase-Only Index. That's that blue line right here. And then the Case-Shiller 20-City Index year-over-year, obviously much more dramatic than the overall FHFA rate. But you can see that Case-Shiller was running as high as 15% in 2014. Now we're down to a little under 5%. So there's been a significant moderation in home price appreciation, which should benefit home buyers in terms of keeping the rate of growth of mortgage payments lower than in 2013 and 2014. And then just the last reason why we think 2015 is different is that economic fundamentals are much better than in 2013. The chart on the left is showing you job growth. We've been averaging 240,000 new jobs in 2015 versus sub 200,000 in 2013. So there's a much higher level of job growth, and unemployment, which is this chart on the right, is down to 5.3% from 7% plus in 2013. So the labor market just looks a lot better than it did in 2013 when interest rates increased 100 basis points. And this red line here is the U6 unemployment rate, which is another measure of labor utilization, which shows you unemployed workers plus part-time for economic reasons and discouraged workers. and that rate has been coming down pretty dramatically as well. All right, so this chart here shows you 3 different scenarios for mortgage payment growth. The light blue line is assuming that home prices increase 4% in 2015 and that rates increase 25 basis points, which would get you to a 4.3% 30-year fixed mortgage rate. This green line shows you HPA at 5% and then a 50 basis point increase in rates. And the yellow line here is plus 6% and a 100 basis point increase in mortgage rates. The Morgan Stanley interest rate base case for the 10-year is 2.6% by the end of the year. So if we assume the long-term average spread between the 10-year Treasury and the 30-year fixed rate, we would get a mortgage rate of 4.3%, 4.2 to 4.3%. So we're sort of expecting mortgage payment growth to be between this light blue line and this green line right here, so 5 to 10% growth, call it. But what's the main takeaway from this chart is that to get back to the levels we saw here in 2013, you would have to see a 100 basis point increase in rates, or just really significant acceleration in home prices. All right, so moving on to the July results from the Morgan Stanley HomeSphere survey. I think the main takeaway from the survey that we had was that we're seeing a moderation in volume and expectations coming off of a strong spring selling season. But on an absolute basis and then on a year-over-year comparison basis, the results of the survey still look positive and still look like they're trending towards our base case view of the housing market in 2015. So just to walk you through this, the chart on the left is showing you new home sales year over year. So we saw a slight improvement in July. 60% of builders stated that new home sales increased year over year versus 56% in June. So a slight sequential improvement, although we are well below, not well below, we're below the highs that we saw in April. 71% of builders in April were reporting higher new home sales on a year-over-year basis. But we are showing a higher rate than in July of 2014. So on an absolute and year-over-year basis, we think the results here are pretty positive. Prospective traffic, though, is continuing to moderate. So 60% of respondents said that year-over-year that traffic was improving year-over-year. So versus July of 2014, 60% of respondents are saying that traffic looks better, which is a deceleration or moderation from April, where 72% of respondents were seeing year-over-year improvement in traffic. All right, and this slide is showing us the sales and pricing outlook. We're again continuing to see moderation in the outlook here, although just on an absolute basis, 73% of builders expect higher new home sales in the next 6 months. 71% expect higher prices in the next 6 months. So on an absolute basis, this is a positive result, but it is important to note that we are seeing moderation from the beginning of the year. Some of that moderation is likely due to seasonality. So as we're entering a slower summer and fall and winter period, we would expect that outlook to come down a little bit, just due to the fact that we're entering a seasonally slower period. Okay, and then this is the cost results. So labor and material costs ticked up sequentially in July, but that segment of builders that are seeing a higher than 5% increase in costs has been flat, which is a positive. Builders seeing 1 to 5% increases in costs were increased, sequentially a little bit to 47% from 45%, but the the percentage of builders that we're seeing higher than 5% is flat, which we read as an incremental positive here. Finished lot cost as well ticked up sequentially, although the percentage of builders that are seeing higher than 5% would tick down a little bit to 14%, so that's the 7 and 7 down here from 15% in June. And then we did see builders reporting 1 to 5% increase, 1 to 5% increase in the cost of finished lots, increased to 36% from 28%. All right, and then the cost outlook has been trending down as well, but still is high on an absolute basis. So the percentage of builders that are expecting an increase in materials and labor costs in the next 6 months has ticked down to 72%. So that's this chart on the left right here, which is down from 78% in June and a high of 89% in February. Again, there's probably some seasonality in these numbers as we enter a seasonally slower period. And then the finished lot cost outlook is essentially flat, with 70% of builders expecting higher finished lot costs in the next 6 months versus 69% in June. So lastly, we're showing the current stage of the housing recovery, so builders' expectations of the current stage of the housing recovery, and then biggest concerns in 2015. So this chart on the left is showing you what inning of the housing recovery our respondents think that we're in. So early, middle, late, or unsure, which is that purple bar at the top, is builders who are unsure about what inning we're in. And the trend throughout 2014 and 2015 has been builders moving away from the view that we're in the early innings and moving into the view that we're in the middle to late innings of the housing recovery. So this chart only goes back to July of 2014, but the results from January of 2014, so a year and a half ago, were 40% of builders thought that we were in the early innings of the housing recovery versus 43% in the middle innings and 10% in the late innings. So contrast that to 5% of builders in July of 2015 think that we're in the early innings of the housing recovery versus 40% who view us in the middle innings and 43% in the late innings. Okay, and just lastly, builders' biggest concerns in 2015. Over the past couple of months, the labor shortage in home building has taken the top slot. So 40% of builders expressed labor shortages as a top concern. That decreased a little bit from June, where 51% of builders were reporting labor as a top concern. And then the cost of building materials, which is up here and has historically been the biggest concern for builders, has actually ticked down a fair amount, but it's still at 45% of builders expect or are listing building materials as a top concern. And then on the demand side, we're seeing lackluster job creation as a concern at 36%. So that's down here. And that's followed by tight mortgage underwriting at 25%, which is down here. All right, so that concludes our survey.